of the maximum contribution for the business owner of an unincorporated entity. The maximum deductible contribution for an owner in an incorporated entity, assuming no other employees, in a defined contribution plan is 25% of compensation. With an unincorporated entity, the maximum contribution is only 20% of self-employment earnings, reduced by the deduction for one half of Social Security taxes. Finally, the plan design considerations change substantially when a self-employed person has other employees. Here we'll only talk about situations when there are no other employees. In HS 354, we'll tackle that issue. For many self-employed individuals who do not have other employees, a SEP is an excellent option. It's easy to establish and maintain as it's funded with an individual retirement account instead of a trust, has simple document and reporting requirements, and is easy to start and terminate. It's also completely flexible as no contributions are required. The maximum contributions allowed if the self-employed person operates as a C corporation or as an S corporation is 25% of compensation. Most self-employed persons are unincorporated, in which case the maximum contribution is slightly lower. It's 20% of Schedule C income, reduced by the Social Security deduction. So if Schedule C earnings are $106,000 and the deduction for Social Security taxes is $6,000, the owner can contribute $20,000, which is 20% of $100,000. The maximum contribution is actually the lesser of the maximum deductible amount or the maximum contribution allowed for an individual under Code Section 415C. In our example, the maximum contribution is well under the 415C limit.
So let's compare the choice of a SEP plan or a 401k plan for the self-employed person. Once again, we are considering situations where there are no other employees. The SEP is undoubtedly simpler and less expensive to establish and maintain. In situations where the self-employed person contemplates only very modest annual contributions, the SEP can be the more reasonable choice. In the past, those wishing to save using Roth accounts would have definitely chosen the 401k, since SEP IRAs previously lacked the ability to offer a Roth election. However, with the recent passage of Secure 2.0, SEP IRAs can now offer Roth accounts. As plan custodians implement this change, SEP plans will become more competitive. When considering the total allowable annual contributions, the 401k plan allows for larger amounts to be saved. Therefore, in situations where the goal is to maximize annual workplace plan contributions, the 401k is preferable. This last point deserves further elaboration. Both SEP IRAs and 401k plans are subject to the same code section 415C maximum annual contribution limit, which is shown on screen. However, the 401k plan also allows for catch-up salary deferrals on top of the 415C limit. This is why for self-employed persons with large annual earnings, the 401k plan offers them a slightly greater tax-advantaged savings capacity. For individuals with more modest annual earnings, but who nevertheless want to maximize allowable workplace plan savings, the 401k plan is strongly favored over the SEP. The self-employed person faces the same limitation on plan contributions as their own employer with both SEP and 401ks, that is, 20% of earnings after adjusting for self-employment taxes for unincorporated business entities. Thus far, there is no difference. But with the 401k, the self-employed person can also contribute up to the current year's salary deferral amount, as well as a catch-up contribution if they have attained age 50. An example drives home the point. Consider a self-employed person with $100,000 of earnings after adjustment for the self-employment tax deduction. They can only contribute 20% of that, or $20,000, into a SEP plan. But with a 401k plan, they can not only contribute the same $20,000 as their own employer, but also $30,000 or more in employee salary deferrals if they are age 50 or older. Not everyone is looking to make such a large contribution, but in the right situation, the self-employed 401k plan is an impressive tax shelter.
Self-employed individuals don't commonly establish defined benefit plans because of the administrative complexity and expense. However, the older self-employed individual looking to maximize contributions to a tax-advantaged plan might want to choose a defined benefit plan. The law doesn't specifically limit contributions to a defined benefit plan, it limits the maximum benefit, which under Code Section 415B is a benefit payable as a life annuity beginning as early as age 62 in an amount which is the lesser of 100% of income or the maximum dollar limit for the year. So, when determining how much can be contributed, the amount is tied to the size of the benefit and the age of the sole proprietor when the plan is established. So, when an older business owner establishes a plan that provides them a maximum benefit, the required contribution each year could be $150,000 or more, well more than the maximum allowable contribution to a SEP or a 401k plan, allowing for the best tax shelter in the right situation.
An individual works for two unrelated employers. The individual can generally have benefits in both plans, and the limits are not related to each other. So the law says when you have unrelated employers, we generally don't have to aggregate the plans for looking at the various qualified plan contribution limits. We sometimes call that double dipping. Well, you will be allowed to do this with self-employment income as well. So if an individual has a job and then they have some additional supplemental income that they get as Schedule C income, the law will allow the individual to set up a retirement plan for that self-employment income. So for example, a corporate executive is on a board of directors of another business, as long as they're unrelated, well, that there can be a plan set up for that self-employment income, that Schedule C income that's paid by the board of directors for that board of director income. And another example would be a professor works at a college and they also have some consulting income. They can establish a plan for that consulting income.
There are a number of exceptions to the general rule. First is for salary deferrals. All salary deferrals to 401k, 403b, and simples are aggregated across unrelated employers, not just related employers. So if for example, a 55-year-old doctor contributes the maximum to a hospital's 403b plan, the doctor cannot make additional salary deferrals in a solo 401k plan for consulting income. But just to illustrate how complicated these aggregation rules can be, there's actually a special aggregation rule for those individuals in a 403b plan. This rule requires that all contributions to 403b plans, plus any contributions to a plan sponsored by a self-employed person, must be added together under a single 415 limit. When we talk about what we mean by related employers, this is really quite complicated. Here, related employers includes all entities that must be aggregated under what are called the control group and affiliated service group rules. To give a simple example, if an individual owns one business and has self-employment income from another source, or a close family member owns a business, the entities may have to be treated as related. The important point here is that if you're trying to maximize contributions by contributing to multiple plans, it's critical to fully understand these aggregation rules.
As soon as a self-employed individual has other employees, it definitely complicates the plan and the planning. So that's a subject that we're going to leave to HS 354, sources of retirement income. And we'll talk about how to cope with making contributions for other employees. But just a couple of quick points. If there are other employees, we still are establishing the same types of plans. We can establish a SEP, or we can establish a 401k plan or a defined benefit plan. And the maximum contribution for the owners is going to be the same, regardless of whether we have other employees or not. The issue becomes that if the cost of covering the other employees. So as soon as we have employees, all of these plans have some sort of coverage rules, and there is a cost involved in covering them. And the larger the contribution for the business owner, typically the larger the contribution for the other employees. Now, there are some design approaches to address that, where we can get a larger contribution to the business owner than to the rank and file employees. We talked about them briefly in the video. And I think let's sort of leave it there, that there are a couple of ways to address that particular issue. But again, we'll talk about that in a future course.
All right, let's keep the studying going.
Choose between a tax-deductible and a tax-exempt retirement account. Advisors often help clients choose between tax-deductible and tax-exempt retirement plans. This question can come up in a number of contexts. One is if a company-sponsored 401k plan has a Roth election, a client may ask, should I make contributions on a pre-tax basis or make the Roth election? Similarly, should I contribute more to a 401k plan or contribute to a Roth IRA? A very similar question. Also, the question, should I convert a traditional IRA into a Roth IRA, has many of the same considerations as these other questions.
Let's consider an example when comparing savings in tax-deferred and Roth accounts. In this example, an investor has $10,000 to save for retirement after paying any taxes on this income. The investor is paying taxes currently at a 25% marginal tax rate. Saving in the Roth means paying $2,500 in tax and then having $7,500 left for the account. Saving in the tax-deferred account allows all $10,000 to be saved after the tax deduction, but the current tax rates would cause the investor to only have $7,500 available on an after-tax basis. Now we look ahead to retirement. Let's simply consider that the investment doubles in pre-tax value at retirement. And we'll consider at retirement, this investor is in 3 different possible tax rates or tax brackets: 15%, 25%. In all 3 cases, the value of the Roth account in after-tax terms will have doubled from $7,500 to $15,000. But the difference is with the tax-deferred account. For the tax-deferred account, it would be the same, that the $15,000 when the tax rate is the same at 25%, and the value would be less if the tax rate increased to 35%. So you choose tax deferral if the tax rate will be lower in retirement. And if there's a higher tax rate, then you would choose the Roth. But if the tax rates were the same, 25% today and 25% in the future, then the accumulated net tax value would be the same in both cases.
It's appropriate to choose tax-deferred plans if tax rates are going to be lower in retirement. And historically, we thought that many people would have lower tax rates in retirement. Instead, deferred plans if tax rates are going to be lower in retirement. And historically, we thought that many people would have lower tax rates.
He said historically we thought that many people would have lower taxes in retirement. We thought what was happening was people, traditional advisors was advising people to put their money in tax deferred because um, one thing that you can surmise or predict is that your taxes are going to be lower when you retire. When actually what ended up happening was the people was ending up paying the same, if not higher, tax rates in retirement. Now it might have not been the same amount of cash leaving because they wasn't making as much money, but it was essentially the same tax rate, if not higher, once they got in retirement. And what did they just say in the screen prior to that? If you think that if taxes are going to be higher in the future, then Roth was the better option when it came to your retirement, qualified retirement account, because what happened was you paid taxes today, a lower rate on taxes today, and then when you retired in the future, uh, when your tax rate was higher, then when you're pulling it out with no taxes, so you benefited. Or they said if the tax rate is the same. Now imagine they're saying, all right, well it's the same, then it's the same difference after taxes and everything. You end up with the same as if you had the Roth. I still don't necessarily agree with that. Because once again, what do taxes do? They don't go down; they go up.
In retirement. Instead, we would choose the Roth tax treatment if tax rates increase in retirement. And essentially, we get the same accumulation if tax rates remain the same in retirement. We may think that we don't know much about future tax rates, but I think there are a few things that we do know. We do know that young people with lower earnings are likely to be in a higher tax bracket later. We also know that sometimes people are temporarily in a low tax bracket, and that may offer some opportunities. Those in the top tax bracket today, many of them do expect that taxes will be higher in the future, and that's a personal decision. Some people believe it will be higher in the future and sometimes believe taxes will not increase. And then we also know for middle income people, they probably are likely to be in a lower tax bracket in retirement. Now, this isn't always true, especially with the elimination of deductions for qualified plan contributions and mortgage interests. So sometimes that, if you look at the individual's tax situation, it may not really be true. And if they leave their money to a beneficiary, a widow, the adult children, or a trust, well, that tax entity, might be in a higher tax bracket than the individual. And that's an important consideration as well.
Another reason to consider contributing to a Roth instead of a tax-deferred plan is that it is actually a way to save more for retirement. For example, if Pete, age 55, is in the 35% tax bracket and he wants to maximize contributions to his company's 401k plan, let's assume the plan offers a Roth election. If the Roth election is made, Pete contributes the full amount allowed for the year as shown on the slide of after-tax money. And if the amount is later withdrawn from the plan, Pete will have 65% of that as after-tax retirement income. If the contribution is on a salary deferral basis, the full salary deferral only reduces Pete's after-tax income by 65% of that value currently, and assuming the same tax rate when Pete withdraws the money, Pete only has 65% of that after-tax retirement income. So the Roth contribution is truly a full contribution and the of after-tax money plan. Let's assume the plan offers a Roth election. If the Roth election is made, Pete contributes the full amount allowed for the year as shown on the slide of after-tax money. And if the amount is later withdrawn from the plan, Pete will have 65% of that as after-tax retirement income. If the contribution is on a salary deferral basis, the full salary deferral only reduces Pete's after-tax income by 65% of that value currently, and assuming the same tax rate when Pete withdraws the money, Pete only has 65% of that after-tax retirement income. So the Roth contribution is truly a full contribution, and the traditional tax-deferred contribution is like a
All right, so let me see if I can understand what they're saying. Example, Pete, age 55, is in the 35% tax bracket and wants to maximize contributions to a 401k. A 27,000 Roth contribution, which that was the limit in 2022, contributions to a qualified plan are indexed each year, which means that each year it typically increases. But for 2022, the maximum contribution for that Roth was 27,000 in after-tax retirement income. All right, so the reason why it's 27,000 is because he already paid the tax liability on the 27,000 because he didn't get any tax break. He just put it in there, and then after tax retirement income, 27,000 equals 27,000. However, if you put the 27,000 in a salary deferral, it only costs Pete $17,550 because the contribution is not taxed. and only yields $17,550 of after-tax retirement income. So this is what they're saying. They're saying, all right, he puts it into a referral, into a tax deferral, a salary deferral. And because he has a 35% tax break, if he's not counting that 27,000 as income for the year, it's really only costing him $17,550 because he no longer has to pay taxes on 35% of 27,000. So because you know um, because technically he's not able to utilize it in that year. But what they're saying is, all right, yeah, all right, you were able to defer it, all right, but when you go to get it out, because you deferred it, when you go to get it out, now that's when you get hit with the taxes. Yes, uh we didn't count you as making this money back then, but now that you're going to get it, here are the taxes, and after we take 35% of that, you're left with $17,550. So essentially, it seems like they keep saying over and over again, if you're somebody that believes that your taxes are going to be higher in the future, definitely utilize a Roth. If you're doing qualified retirement accounts, if you're somebody that believes that your taxes are going to be the same, according to them, then you're going to end up, after everything, all things considered, with the same amount. In my opinion, so if they're telling it's going to be the same, you think, all right. Most likely, if you ask people what's going to happen with taxes, everybody says that it's going to go up, it's going to increase. So if you think that most likely taxes are going to increase or stay the same, in my opinion, you go with Roth. But according to them, if you wanted to, out of the three options, whether whether it's going to be higher, the same, or lower, if you believe out of the three options, the lower option, then according to them, you go with the traditional, because that way you are able to pay the higher, you're able to avoid the higher liability, and then when you go pull it out, it's going to be a lower amount. I still think Roth, if you're doing qualified retirement accounts, Roth is the way to go.
Contribution of 65% of that value.
There are other reasons to consider using Roth tax treatment as well. With Roth IRAs, there are no required minimum distributions during the life of the participant. This means that you can save the money until you need it in retirement. Maybe you consider it the longevity fund or a fund that can be used for liquidity needs at some point in time. And if the money's not needed in retirement, well, it makes it great tax efficient assets to leave for heirs because they receive the entire account tax free. In addition, you can create tax diversification by establishing a Roth account. So if you have both Roth accounts and tax deferred accounts, you can do some income tax bracket planning. If you don't have any Roth account, a lot of times if you take all your money out of your qualified plan, well, you're going to have to pay income tax on the whole thing. And if tax rates go up, you really have a problem. So here you have an opportunity to choose between taxable and tax exempt earnings. Another issue is that Roth distributions aren't counted for determining Social Security taxation, so you can do some planning there as well. And Roth distributions are not counted for determining your Medicare premiums, which today are based on your income. With Roth IRAs, there are no required minimum distributions during.
All right, so this is very important, because as you get older, it becomes very important where your streams of income are coming from. You know, as you're working, a lot of our income is considered active income, and due to that active income, certain social programs, quote unquote welfare programs, you know, you don't have access to because of how that stream of income is coming to. Let's see what he's saying. He's saying that if the income is coming from Roth, what is he saying?
The life of
Because you know, depending on your income determines, you know, your access to the Medicaid you might have to have in addition to your Medicare. Maybe got Medicare Advantage and all of that good stuff. Depending on your income determines your access to those type of programs.
participant. This
Medicare is an entitlement. Medicaid is like a welfare type of setup.
means that you can save the money until you need it in retirement. Maybe you consider it the longevity fund or a fund that can be used for liquidity needs at some point in time. And if the money's not needed in retirement, well, it makes it great tax efficient assets to leave for heirs because they receive the entire account tax free. In addition, you can create tax diversification by establishing a Roth account. So if you have both Roth accounts and tax deferred accounts, you can do some income tax bracket planning. If you don't have any Roth account, a lot of times if you take all your money out of your qualified plan, well, you're going to have to pay income tax on the whole thing. And if tax rates go up, you really have a problem. So here you have an opportunity to choose between taxable and tax exempt earnings. Another issue is that Roth distributions aren't counted for determining Social Security taxation, so you can do some planning there as well. And Roth distributions.
All right, so that's bigger than most of y'all realize. Roth distributions are not counted toward uh determining your Social Security taxation. A lot of people don't know that Social Security is taxable depending on if you are considered someone who quote unquote does not need as much Social Security as somebody else. And what this is saying is if you were to contribute to a Roth 401k or other type of qualified retirement account due to the Secure 2.0 Act. Looks like you can also make your SEP IRA a Roth. Of course, you can also make your regular IRA a Roth, and of course your 401k, 403b, those different things. But you really want it to where the income that you have coming in does not adversely affect that Social Security. You know, that money that they take out every couple of weeks whenever you get your paycheck, and it's money that you earned but you can't use, and it's supposedly for you in the future when you need it, your Social Security. You want to get every bit of that. So if you're getting income from a Roth as opposed to a traditional, that income from a Roth will not be counted toward determining if your Social Security could be taxed. So now you'll potentially be able to get all of your Social Security instead of just a portion of it. Up to 85% of Social Security is could be taxed depending on where your income is coming from.
Are not counted for determining your Medicare premiums, which today are based on your income.
And remember, I said that Medicare is an entitlement, meaning that you've earned it, you're entitled to it. When you was paying that FICA included Social Security, that FICA also included Medicare, but you still have to pay premiums for that Medicare. And if you're making, if you have a lot of income coming to you in retirement from the wrong sources that's showing up on the front of your tax return, now not only is your Social Security getting taxed, but now your medical premium, your Medicare premiums are higher.
Income. The considerations for whether or not to make a Roth IRA conversion are essentially the same considerations that we just discussed with regard to whether or not to make a Roth election or not in a 401k plan. Because of that, it's a really good idea to look for times to do conversions when tax rates are currently low. So if you have a particular year where you have low income, you have a good opportunity to do a Roth conversion. Again, you also have to consider, like with the Roth IRA contribution, you have to consider projections of future tax rates here. So if we expect future tax rates to go up, well, that would be a good reason to do a Roth conversion now as well. Another way of looking at the Roth conversion is that you're prepaying a future tax obligation. Sometimes people have a hard time paying more taxes than they need to, but I think of it as a different way of saving for retirement because you're eliminating a future obligation, which in today's environment is quite uncertain. So you've eliminated an uncertain future obligation. For state and federal inheritance taxes, there may be an advantage to doing a conversion as well, because when you do the conversion, you pay some income tax and immediately you lower the value of the estate, and that will lower any estate taxes.
Another good opportunity to convert is when asset values are depressed, since taxes are paid on the value at the time of the conversion. Of course, if we could all time the market, we wouldn't need clients. so identifying the right date to convert is no easy matter. However, a principle to keep in mind is if the market is in a down cycle or is quite volatile and is temporarily down, those are great times to convert as it reduces the tax burden. There are also situations in which conversions may not be a good idea. If you take middle and low income individuals, especially those that are marginally funded for retirement, they're more likely to be in a lower tax bracket in retirement, and as a general rule, conversions will not be appropriate. Another way to put this is it doesn't make sense to further reduce what may already be marginal resources by prepaying taxes through a conversion. However, there could be exceptions, and it's still a good idea to convert at a lower than normal tax rate. Maybe in some cases, even small amounts can be converted at a 0% rate. There are also a couple of other concerns to point out when doing a conversion. It's important to recognize that in the year of the conversion, adjusted gross income will spike, and this can cause new tax problems. Be sure to include the client's tax advisor in any conversion deliberations. Another concern is the elimination of the ability to recharacterize a conversion. Up until 2018, an individual that converted to a Roth IRA could undo that transaction through what's called a recharacterization. This allowed the individual to undo any portion of a conversion up until the due date of the individual's tax return, including extensions. This tool is quite helpful in two situations. One, you didn't have to worry about converting too much because later, let's say after you had a better understanding of your tax situation, you could recharacterize any portion of the original conversion. So now a planner doesn't have that latitude. It means needing better tax projections before the end of the year so the proper amount can be converted by 12/31. Recharacterization was also helpful when there was a decline in the value of the asset after it was converted. The asset could be recharacterized and later reconverted at the lower value, reducing the tax burden on the transaction. This opportunity is now gone. The main point here is that the advisor needs to make sure that they communicate to the client that taxes are paid based on the value on the date of the conversion, even if there's a subsequent decline in value.
Okay. So that was good stuff. Sounds like Roth. If you're into qualified accounts, Roth is the way to go.
Strategies for maximizing
Notice I
tax.
keep saying if you're into qualified accounts, meaning that there might be other options, maybe even better options than a qualified account, traditional or Roth.
Advantage savings. In the previous two learning objectives, we covered some of the options that may be available for individuals saving for retirement. But here we want to apply it to a specific client situation. To do that, the first thing you have to do, of course, is understand the client's particular situation. If the individual is working, are they eligible for a 401k plan? Are they eligible for a simple? Is the client eligible for a non-qualified deferred compensation plan? If the individual is self-employed, is that supplemental self-employment income? We pointed out that that was an important issue, whether it was supplemental or if that was their sole job. And if they are self-employed, do they have any employees? That also comes into play. Those are all important facts to learn. You also need to determine the individual's eligibility for IRA or Roth IRA contributions. And to do that, you're going to need to know the individual's marital status, their tax filing status, their adjusted gross income, and whether they're an active participant in an employable saving for retirement. But here we want to apply it to a specific client situation. To do that, the first thing you have to do, of course, is understand the client's particular situation. If the individual is working, are they eligible for a 401k plan? Are they eligible for a simple? Is the client eligible for a non-qualified deferred compensation plan? If the individual is self-employed, is that supplemental self-employment income? We pointed out that that was an important issue, whether it was supplemental or if that was their sole job. And if they are self-employed, do they have any employees? That also comes into play. Those are all important facts to learn. You also need to determine the individual's eligibility for IRA or Roth IRA contributions. And to do that, you're going to need to know the individual's marital status, their tax filing status, their adjusted gross income, and whether they're an active participant in an employer-sponsored plan. And if they're married, you also need to know the active participant status of the spouse. It's also relevant what the current tax rates will be and expected future tax rates as well, if we have any specific information about that. For example, we know that income is definitely going to increase into the future. And another part of the planning here clearly is other plans that are in place. In the last learning objective, we compared Roth tax exempt to tax deferred plans. And we said one thing we want is some tax diversification. So knowing what other types of plans we have definitely comes into play into making the choices here. Before we look at some case studies, let's just think through some of the considerations that you want to have in mind when you're trying to maximize contributions to tax advantage plans for your clients. The first is consider all types of plans. So make sure you're considering IRAs, self-employed plans, employer-sponsored retirement plans. Second, look for assets to contribute. We think of these as plans that you contribute current compensation, but in many cases you can actually fund the plan with other assets. And I think a lot of people don't take advantage of one simple idea, which is if they're eligible for a Roth IRA, just taking after-tax accounts or after-tax investments and contributing them to a Roth in order to get tax-free treatment is something a lot of people, I think, forget to do. Another thing to keep in mind is just this idea that you can make additional contributions to the salary deferral plans after age 50. That includes the 401k plan, Simples, and you can even make additional contributions to the IRA after age 50 as well. Also, we want to think about using a variety of plans, both tax deferred and Roth, for some tax diversification. We really don't know what will happen in the future. So that's one reason to use both types of plans. Also, when you have tax diversification, you can do better tax planning on a year-to-year basis. And finally, a lot of people don't have a Roth IRAs at this point in time, or they have very small contributions to Roths. If you're trying to develop a Roth, doing a Roth conversion is clearly one way to do it. And if you can take withdrawals from a qualified plan at a very low tax rate and convert it to a Roth in the expectation of a higher tax rate later, that's always a good idea. So now let's look at some case studies.
The following case studies contain very practical and important examples of how you can help your clients maximize their contributions to tax advantage workplace retirement savings plans, as well as to individual retirement arrangements or IRAs. As you work through these case studies, you'll notice that many of the limiting contribution dollar amounts are from 2022, not the current tax year. Don't let this small detail detract from the learning value contained in these case studies. In fact, as a personal learning exercise, consider then reworking each case study to arrive at new recommended contribution strategies. After all, this is exactly the sort of contribution planning adjustment that you'll be facing each new calendar year for your clients.
Sam, age 55, and married to Sally, who's age 52, inherits $80,000 from Aunt Martha in March of the year. Now, Sam would like to save as much of this as possible for retirement, and he's comfortable titling some of these assets in Sally's name. Now, they each earn $70,000 from work. They each contribute 6% to their company's 401k plans, and Sam earns $20,000 from additional consulting income from an unrelated business. Their adjusted gross income is approximately $160,000.
Sam and Sally will be able to save a lot of their inheritance in tax advantage retirement plans, and here's how they will do it. First, Sam and Sally open Roth IRAs by April 1st, and each contribute the allowed contribution amounts for the previous year and the current year for a total contribution as shown on the screen. Sam opens a SEP and contributes 20% of consulting income, reduced by the Social Security deduction, totaling about $3,700. Their Roth IRA and SEP contributions total $31,700, which will leave $48,300 from the inheritance. Sam and Sally also currently contribute 6% of salary, or $42,000 each, to their 401k plans. So they each increase deductible contributions by the amount shown to reach the maximum deductible contribution shown. Assuming a 22% tax rate, the additional deductible contribution means that their after-tax take-home income is reduced by the amount shown. They can replace this reduced income from their remaining inheritance, leaving them with the amount shown. This leaves them enough for a nice vacation and maybe still have a bit remaining to contribute to their Roth IRAs next year.
Ahmed is single, age 58, with $150,000 of adjusted gross income, and his company sponsors a 401k plan with a Roth election. Now, Ahmed would like to maximize contributions to the plan. He expects the tax rates now and at the time of withdrawal will be the same. Currently, he only has tax-deferred accounts. He does not have any Roth IRAs or Roth accounts accumulation.
We know from the facts that Ahmed expects tax rates will remain the same in retirement. This means he derives similar tax benefits from both tax-deferred and tax-exempt Roth contributions. But the other facts lead him to make the Roth election. First, he has no Roth accounts or Roth IRAs, so he needs tax diversification to give him more control over his taxes in retirement. He also wants to save the most.
With a $27,000 Roth contribution, that is $20,500 salary deferral, and a $6,500 catch-up contribution, he will have created $27,000 of after-tax income for retirement. If instead contributions are on a tax-deferred basis and he is in the 24% tax bracket, the $27,000 contribution reduces his current after-tax income by only $20,520. But when he gets into retirement and has to pay taxes, he only has $20,520 of after-tax income.
Diego and Dominga are in their mid-50s. They each work and they're contributing as much as they can afford to their employer's 401k plans. Their adjusted gross income is $95,000. They do have a $20,000 CD maturing that they're saving for retirement.
Be right back. How long does the lettuce typically stay good for? Like in a couple of days? Come on, the lettuce you just bought? Like you know I'm not eating Monday and Tuesday, so that don't matter. I'm just saying, but you know what? Yeah. Yeah, I was just sharing that with you. I'm back.
In their minds, they have no more money that they can afford to contribute to a retirement plan. But is there any other way they can improve their situation?
Each spouse can contribute $7,000 to a Roth IRA from the proceeds of the CD. If it's before April 15th, it may also be possible to contribute for the previous year and for the current year. So clearly, at least at the beginning of the year, we could shelter all $20,000 of those proceeds from the CD. Once you make the contribution to a Roth IRA, you can invest in whatever you want, and you can again use a CD if that's what you prefer to have. Now, some clients may be reluctant to make this change from this taxable account to this Roth IRA, but remember that with a Roth IRA, you can take contributions at any time without tax consequences. So they're still pretty liquid. Now, again, if you invested in a CD and you wanted to take withdrawal, you might have to pay a penalty in that case. But that would from this taxable account to this Roth IRA. But remember that with a Roth IRA, you can take contributions at any time without tax consequences. So they're still pretty liquid. Now, again, if you invested in a CD and you wanted to take a withdrawal, you might have to pay a penalty in that case. But that wouldn't be different if you bought the CD inside or outside of the Roth IRA environment.
Francisca, age 45, leaves her well-paying job and starts a consulting business. Her prospects look good in the future, but her first year's self-employment earnings are only $40,000. She can live on this amount, but she can't see saving more for retirement. She has a $160,000 rollover IRA and $110,000 of after-tax savings and investments.
This year poses some interesting ways for Francisca to reposition some of her savings into tax-advantaged savings. First, Francisca can set up a solo 401k plan and use her after-tax savings to contribute almost $28,000 on a tax-deductible basis to the plan. This means making the maximum salary deferral of $20,500 and contributing the maximum profit sharing amount, which for a sole proprietor that is not incorporated is 20% of her self-employment income of $40,000, but reduced for her Social Security deduction, which represents 1/2 of her self-employment Social Security taxes. What this large contribution does is lower her taxable current income even more, making it a great year to convert some of her IRA to a Roth IRA, paying the taxes with some of her after-tax savings.
Lee and Linlin are both age 58. They're married, have adjusted gross income of $300,000. Both are employed and maximize contributions to their company's 401k plans. They do not currently have any IRA accounts. They are good candidates to establish non-deductible IRA accounts, contribute the maximum amount, and then immediately convert those amounts into a Roth IRA. Since they do not have other IRAs, the conversion will be tax-free, assuming no earnings accrue before the conversion occurs. Now, the situation is more complicated if they have other IRA accounts, because when they do the conversion, there will be some tax consequences to doing the conversion.
Sandra Sanders, age 63, is married and files a joint tax return. The couple's AGI is $300,000 for the year. She started a training business operating as an unincorporated entity, and she has no employees. Her Schedule C earnings are $65,000, and her deduction for 1/2 her self-employment taxes is $5,000. She's in the position of being able to save as much of her income as possible for retirement. What are her options?
Sandra can save a lot by establishing a retirement plan for her business. If she chooses a SEP, she could contribute $12,000, which is 20% of $60,000. If she wants to save a lot more, she is the perfect candidate for a solo 401k. She could contribute $39,000, which includes a $12,000 profit sharing contribution, $1,500 in salary deferrals, plus $6,500 as a catch-up contribution since she is over the age of 50. Remember, she could also make a Roth election on some or all of her salary deferral and catch-up contributions as long as she chooses a plan that allows her to do this.
She can probably shelter most, if not all, of her income if she adopted a defined benefit plan, but that's a lot more complicated, with substantial additional administrative expense. And for it to work, she must really make a commitment to this course of action going forward. So she can adopt any of these three employer-sponsored plans. But in addition, she could also make a $7,000 non-deductible IRA contribution. And as long as she doesn't have any other IRAs, she could convert that amount to a Roth IRA without any income tax consequences.
Alex and Alicia are married. They're each age 63 and they're retired. They're taking $80,000 of withdrawals from their taxable investment account to pay for living expenses. Now, they've made some good choices already. They're deferring Social Security benefits, and they're holding on to their substantial 401k accounts until later. They're spending their taxable accounts first. They don't have any Roth IRAs at this point. Now, because of their current strategy, they have very low taxable income for the year. They're not taking out anything from a taxable account. So they only have earnings on the taxable account. So they have a very low taxable income. Is there any other option that can improve their situation in this case?
They're great candidates for converting a portion of either of their 401k benefits to a Roth IRA. With the accountant, they do as much as possible and still have a 12% effective tax rate. In the future, their taxable income is going to go way up as they start taking qualified plan withdrawals and receive Social Security benefits. And this is a great time to build a Roth account and reduce their future required minimum distributions from their 401k plans as well. Section 4, Deferring Social Security. Social Security benefits can begin as early as age 62, but benefits increase for every year of deferral up to age 70 by 7 to 8%. Deferring benefits means a larger income floor, cost of living protection on the deferred benefit, and a larger benefit for a surviving spouse. In this section, we discuss how to frame the Social Security claiming decision and describe the advantages of deferral.
Understand how deferring Social Security can improve a client's situation. In this learning objective, we're going to start out by pointing out the impact of deferring Social Security benefits. Next, we're going to discuss how you frame the issue. And we're trying today to get people to think more of this as a way to increase annuity income, but we'll also talk about the more traditional break-even analysis approach. Then we'll talk about some practical ways that can help a client afford to defer benefits. Where are they going to get the funds to cover the Social Security benefits they're not going to receive by deferring? And finally, we want to point out that in this course, we have one learning objective on the Social Security issue, but in HS 354, Sources of Retirement Income, we're going to have a whole competency on Social Security because this is a very important decision for many, many clients. Most retirees would benefit from an increase in guaranteed income. Social Security provides an inflation-adjusted annuity guaranteed by the government, and benefits are payable for life, and for married couples, the higher benefit is paid for the joint lives of the couple. And today, many retirees do not have any other guaranteed lifetime income. And research has shown that retirees with greater amounts of guaranteed income show more satisfaction, they worry less, and they show fewer signs of depression. Understand how deferring Social Security. In this learning objective, we're going to start out by pointing out the impact of deferring Social Security benefits. Next, we're going to discuss how you frame the issue. And we're trying today to get people to think more of this as a way to increase annuity income, but we'll also talk about the more traditional break-even analysis approach. Then we'll talk about some practical ways that can help a client afford to defer benefits. Where are they going to get the funds to cover the Social Security benefits they're not going to receive by deferring? And finally, we want to point out that in this course, we have one learning objective on the Social Security issue, but in HS 354, Sources of Retirement Income, we're going to have a whole competency on Social Security because this is a very important decision for many, many clients. Most retirees would benefit from an increase in guaranteed income. Social Security provides an inflation-adjusted annuity guaranteed by the government, and benefits are payable for life, and for married couples, the higher benefit is paid for the joint lives of the couple. And today, many retirees do not have any other guaranteed lifetime income. And research has shown that retirees with greater amounts of guaranteed income show more satisfaction, they worry less, and they show fewer signs of depression.
Deferring Social Security not only means more guaranteed income, it also means a higher percentage of income that has inflation protection. Each year, Social Security benefits are increased to match the previous year's rise in the Consumer Price Index for urban wage earners, abbreviated as CPI-W. It is very difficult and expensive.
I keep
Most retirees would benefit from an increase in guaranteed income.
losing my train of thought.
Social Security provides an
Start it over.
inflation-adjusted annuity
Don't
guaranteed
give
by the
up.
government, and benefits are payable for life, and for married couples, the higher benefit is paid for the joint lives of the couple. And today, many retirees do not have any other guaranteed lifetime income. And research has shown that retirees with greater amounts of guaranteed income show more satisfaction, they worry less, and they show fewer signs of depression.
Deferring Social Security not only means more guaranteed income, it also means a higher percentage of income that has inflation protection. Each year, Social Security benefits are increased to match the previous year's rise in the Consumer Price Index for urban wage earners, abbreviated as CPI-W. It is very difficult and expensive to recreate this type of inflation protection using commercial annuities. Currently, no commercial annuities offered in the United States have annual payout increases linked to CPI. And even prior to 2019, when such annuities were being offered, the annual increase was capped so that in years with very high inflation, the payout could lag actual inflation. What is currently available through commercial annuities is a fixed annual percentage increase in payouts. A common choice here would be annual increases of 2 or 3%, but this payout comes with a corresponding decrease in the first year's payout, and it still doesn't offer protection from unexpectedly high inflation, like what is available with Social Security benefits.
Since deferring Social Security is a way to increase inflation-adjusted lifetime income, for many, deferring Social Security is often the simplest way to improve their situation. If you're trying to explain this to clients, a good starting point is simply what happens for each year that benefits are deferred between ages 62 and 70. The answer is that benefits increase for each year. Benefits are deferred by approximately 7 to 8%. It's also helpful to look at the actual numbers, which can be generated by Social Security calculators or commercial software. Besides showing monthly increases, also show the amounts in annual numbers. It simply looks bigger. Maybe more important, show the increased benefits as a percentage of pre-retirement earnings that is replaced by Social Security. To illustrate what I mean, let's take a couple. Both are about to be age 62 and each earn $60,000 a year. Using Social Security's quick calculator, we can estimate their retirement benefits at different ages. As the table shows, if they both claim at age 62 and we take their combined annual Social Security benefit as a percentage of their $120,000 of income, their benefits replace 23% of their income. If they continue to work to age 66 and then claim benefits, Social Security replaces 33% of their income. And if they wait to 70, Social Security replaces 45% of their income. This doesn't tell the full story. Many don't need to replace their entire income to meet retirement needs. Let's say they only need 80% or $96,000 a year of income in retirement. Now note that if they claim at age 70, Social Security meets 57% of their retirement need, and that is inflation-protected income for life. I think it's also helpful to give another illustration showing just how much money is involved for wealthier clients when making the claiming decision. Financial advisors work with many clients who earn more than the taxable wage base. Assuming a long enough work history, these individuals are eligible for Social Security's maximum retirement benefit. For an individual retiring in 2018 at full retirement age, the maximum benefit is $2,788 a month which is $33,466 a year. If the individual claims at age 62, the benefit is 25% less, and they are entitled to $2,159 a month or $25,908 a year. And if they wait to age 70, the benefit is 32% more than at age 66, and it will be $3,698 a month or $44,376 a year. So a client waiting from age 62 to 70 receives almost $20,000 a year more. Another way of looking at this is if you have married clients and both spouses are eligible for the maximum Social Security benefit, by waiting to 70, the couple's eligible for almost $90,000 a year of inflation-adjusted lifetime income. Everyone wants a good deal from Social Security. A common way of looking at whether you're getting a good deal is through a break-even analysis. Consumers often look at this as if you wait to take Social Security, it will take many years to make up for the lost payments, and you'll lose out if you don't live that long. Consumers often forget that the opposite is also possible, and if you do live a long life, you're better off deferring. The mathematical way to look at this is to calculate the total benefits received over the lifetime, assuming different life expectancies, and then look for the break-even point. Live shorter than that, and the better deal is to take early. Live longer, and the total lifetime benefits will be larger by deferring. The break-even age will depend on discount rates, but it is commonly considered between ages 80 and 83. The flaw with this analysis is simple. We don't know how long we're going to live, and betting on a short life expectancy is a bad gamble. If you lose the bet, it means living a long time and not having enough money later in retirement. You can argue that wealthier clients are in a better position to use this analysis, as they are not as dependent on Social Security and they're just looking for the best deal. But we also know that wealthier individuals on average live longer, meaning that they often benefit from deferring under this analysis. A final important consideration is that the analysis is more complicated if you're married. We'll talk more about this on the next slide.
For a married couple, when one spouse dies, the surviving spouse receives the higher of the two retirement benefits. So if we have a married couple and let's say the worker has a short life expectancy, even in that situation, it might not make sense to start benefits early because the spouse may have an average or even the possibility of a long life expectancy. And by taking early, you're saddling that spouse with that lower benefit for the rest of the spouse's life. There's another issue for married couples as well. You would think that Social Security benefits would provide the actuarial equivalent at different ages if people lived an average life expectancy. So forget gambling on living too long or living a short life. For those people that live an average life expectancy, you would assume that the present value of payments would be the same if you began at age 62 or 66 or age 70. But that really is not true because of the spousal benefit, or often called the widow or widower benefit. Because of that benefit, when you have married men who have the larger Social Security benefit, even those that live the average life expectancy, who retire and begin benefits early, they receive a smaller present value than if they were to defer benefits. So couples in that situation, the married men should defer to get the better deal. And that's on average. That's not just based on someone who's going to live a long time. At the beginning of this section, we talked about the value of having additional life annuity income. Then we just talked about how many people have framed the Social Security claiming decision as a break-even analysis. And what I think many professionals are trying to do now is change that framing or change that approach and look at deferral as purchasing additional life annuity income. And the cost of that is the lost payments because of the deferral. And it's really pretty easy to determine whether it's a good deal in terms of an annuity purchase by comparing the actual price of purchasing an inflation-adjusted annuity in the amount that the benefit will increase from Social Security. And I think in most cases, you'll find that it's going to be the cheapest annuity that you can purchase.
For those that are thinking of deferring Social Security benefits, there is the practical issue of how do they support themselves while they're deferring Social Security. Well, one way is to continue working either full or part-time. Another is using other assets while they're to live on while they're deferring Social Security benefits. For example, taking withdrawals from a 401k plan. And then for those who have already begun benefits, let's say they lost their job and started Social Security, if they're lucky enough to get another job, well, they can actually stop their benefits and improve their situation that way. The biggest impact of continuing to work is that it provides income during the period that you are deferring Social Security benefits. Full-time work can also have some impact on the calculation of benefits. It has the biggest impact when the worker has fewer than 35 years of wages, because the current earnings replaces zero when calculating average earnings over a 35-year period. Also, of course, higher earnings replace lower ones, so current wages could slightly increase benefits even for the person with more than 35 years of employment. Part-time work again provides income to support deferral of benefits, but is less likely to have an impact on the calculation of average earnings. The impact of continued work should be easy to figure out. Social Security's most accurate calculator, simply referred to as the Social Security downloadable calculator, can provide a clear understanding of the impact of additional work on the calculation of Social Security benefits.
So another scenario is you have a client who doesn't continue to work, but let's say they retire at age 62, and now they're choosing to start Social Security benefits at 62 or defer Social Security benefits and use other assets during this bridge period. And they're trying to figure out which situation would leave them in a better position. So the annuity purchase model that we talked about before might appeal to some clients, this idea that the money that they're going to spend, let's say out of their 401k account, this is tantamount to the purchase price of this additional annuity, and it's probably the least expensive annuity that they could purchase. That might be one approach. But another approach to this question is offered by Bill Reichenstein, and that we're going to see in the next video. And he looks at how long will the portfolio last under each scenario, meaning starting benefits at 62 and taking out a little bit from the portfolio each year, or taking out or deferring Social Security benefits till later, and in those first few years taking up much more out of the portfolio. And interestingly, he actually finds in the case study that he's talking about that the portfolio lasts longer in start benefits later, you defer benefits, even though there's more benefits or more withdrawals from the portfolio in those first few years.
In the claiming decision, an important issue for people, a real issue, is, okay, I can take Social Security. Let's say I've stopped work at 62. Let's start with that as an example. And now the question is, do I start Social Security now, or do I use other assets to make up a bridge period? We've talked about some reasons why people might want to defer their Social Security benefits, but people are going to have to make this real and fairly tough decision to, it's hard to start spending those assets out of your 401k account. So let's say that's the choice. Can you sort of take us through that decision and give us some reasons why it might? I think we're going to find out in many cases it's you might want to consider taking those 401k assets out first.
Correct. In a little bit more details on this one, I'm going to talk about an example I presented with my co-author Bill Meyer in the March 2010 issue of Journal of Financial Planning. Well, there we took a single individual with $700,000 in a 401k and wanted to live on, if I remember the exact amount, it was $41,700 after taxes each year. We started with the 2009 tax code, and he retired at 62. Mm-hmm. And we looked at, that's the decision to retire, but that doesn't mean he has to begin Social Security, as you said. You could delay the Social Security. And where did we get the $41,700? That was the amount. If you started at 62, the portfolio, and we used a conservative rate of return of 5% and 2.5% for inflation, and the portfolio runs out after 30 years.
Okay.
Then we turn and say, well,
If you withdraw that amount.
yes. Okay. Or you're spending that amount each year. Now, what would happen? Of course, the first year there, you're taking out relatively little from the 401k because you got the Social Security kicking in. But what if he or she, will make it a she, that she delays Social Security until 64? So the first 2 years, she takes more money out of the 401k, but now she's got a larger amount. Well, as it turns out, still living on $41,700 a year after taxes, the portfolio lasts 1.5 years longer.
Let's just set the stage again, because I'm not sure I understand it.
Okay.
So we go back to at 62. Let's just start with the assumption you're going to take Social Security and then take additional assets out of the portfolio. And you said, okay,
yep.
The idea was,
so she was going to live on $41,700. She, if I remember the exact number, she was going to get $13,500 from Social Security.
Okay.
So take the remainder amount, roughly $28,000 plus any taxes,
okay,
and take that out of the financial portfolio.
All right, and that's what was going to last for 30 years.
30 years.
Okay.
And then we said, let's change it. In the first 2 years, she's going to take all the money she needs out of the 401k.
Okay.
And then at 64, she's going to now start with a higher amount of Social Security. So each year after that, she'll have to take a smaller amount out of the financial portfolio, out of the 401k. And as it turns out, if you go out to about 80, if she lives to about 80, you get the crossover again. But what if she lives longer? She instead of the portfolio running out at 90, it now runs out at 91.5. And by delaying Social Security to 66, instead of the portfolio running out at 91.5, it's about 93. And it goes out, if she waits until 70, so the first 8 years, she's taken that financial portfolio from 700,000. I forget exactly how low it fell, but it fell probably, let's say, in half. But from that point on, she's got this 76% higher Social Security benefit. Mm-hmm. So she needs to take a relatively small amount from her financial portfolio each year. And just because of the way Social Security works, what's the longevity risk? You're really worried about, what if I live a long time? I don't want to run out of money. Mm-hmm. Well, if you live a long time, delaying Social Security is the right decision. You get cumulatively more benefits. So it's okay to run down your financial portfolio from 700,000. You may lose a lot of it over the first 8 years, but now you've got this 76% larger Social Security benefit for the rest of your life, and that's in real terms. So you'll need relatively small amount to be withdrawn from the 401k. And if you do live to be in the 100, if your portfolio runs out, you still have 76% more that you can't outlive.
And you said that your analysis looked at after-tax dollars. So
we were assuming she was taking $41,700 spending each year.
Spending, okay.
Yes. So after-tax dollars.
So when you start mixing and matching Social Security with other assets, there's this, we sometimes call the tax torpedo. There's some relationship. Yes. So I would imagine that was in the analysis as well, or?
Yeah, on that one we have, in our model, we have built in the taxation of Social Security.
Right.
And one of the advantages of taking the money out of the 401k at 62, or if you wait till 70, so you're living off of the 401k, from 62 to 70, you draw down that 401k pretty far. Now she starts required minimum distributions, which she just needs less at that point because she's got more in Social Security. As it turns out, you can reduce the amount of taxation on Social Security because you have relatively little bit coming out from the 401k, and it's called provisional income, sometimes combined income. The taxation of Social Security, it's in this case here, it'd be the 401k distribution plus 1/2 of Social Security.
Right.
And it actually turns out by reducing those 401k balances in those early years, 62 to 70, you reduce the taxation of Social Security.
Right. So especially your example is sort of a middle income type person, and that's where you see that tax implication have a big impact on.
Yes. What happens is it's called the tax torpedo sometimes, but there's a stage where every time you take another, let's call it $100 out of the 401k, it can cause either another $50 or $85 of Social Security to be taxable. So you may think you're in a 25% tax bracket, but if that extra $100 causes your taxable income to increase by $185 because you're bringing in extra an extra $85 of taxation of Social Security, you're actually, of that $100, you pay $46.25, I think it is, in taxes.
Yeah.
So you're actually in a very high tax bracket. We try in our software to help people minimize that to the degree they can.
Yeah, I really like the way you've analyzed this, because I think ultimately when you're asking someone at 62 to start taking money out of their 401k plan instead of Social Security, they're worried about depleting that more quickly.
They look
and you're going to illustrate to them that if they do that approach, their portfolio will actually last longer.
That's
Great
right.
way to look at it.
You got to look at it isn't just that financial portfolio. That's what they look at, and that's what they have control over. But by delaying to Social Security, they get that 76% more in real terms for the rest of their life. They're also using the tax code. They'll have less of Social Security being taxed. And actually, if their objective is, I don't want to run out of money in my lifetime, their portfolio will actually last longer by delaying.
That's terrific. Thanks a lot.
Thank you.
This video was made possible by the New York.
You may occasionally have a client that is forced to begin taking Social Security benefits due to involuntary termination of employment, and they simply need the income to pay the bills. There are several ways to help these individuals improve their situation. First, if they are reemployed within a short period of time, Social Security allows claimants a one-time do-over. This requires paying back all the benefits that have been paid within 1 year of benefit commencement. The filing decision is rescinded, and the recipient can later claim without having the original filing have any impact on the calculation of benefits. The suspension of benefits rules can also be helpful. When an individual starts benefits early and then gets another job, under the earnings test, wage earnings prior to attaining full retirement age can result in the forced suspension of benefits. Even though benefits can be stopped or reduced, depending upon the amount of earnings, the benefits are recalculated at full retirement age to reflect the loss of benefits under the earnings test. Also, if benefits have started early, anyone is allowed to voluntarily suspend benefits once they've attained full retirement age, and then they can turn the benefits on again later, presumably at age 70, in order to maximize benefits. Again, benefits are increased to reflect the time the benefits are not received. These strategies can also be useful if you have a new client that you find out had claimed benefits early, has not yet reached age 70, and is now wondering if they can improve their situation.
For many, the Social Security claiming decision is the most important retirement income decision they will make, because approximately 2/3 of retirees receive more than half of their income from Social Security. Unfortunately, many still take benefits as early as possible at age 62. It's used to be about half of the new beneficiaries claimed benefits at age 62, but that number in recent years is beginning to fall. It is important to not make the Social Security claiming decision in a vacuum, but instead as part of a comprehensive retirement income plan.
Finally, let's go through a checklist of steps required to help a client make better Social Security claiming decisions. First, determine the client's eligibility for benefits, including workers' benefits, spousal benefits, or survivor benefits from current or former marriages. Next, review the client's latest Social Security statement that's available online. Based on the client's situation, consider reasonable alternative claiming options and then do detailed calculations under each scenario using the Social Security Detailed Calculator or other tool. If you're going to suggest to a client that they defer benefits, you will also need to identify a source of income for the bridge period. The last step, that is before presenting the options to the client, is to evaluate the impact of the viable claiming options, typically using software tools that are available to many advisors. We'll discuss some of them in the next course.
Riveting. Now let's tap this home equity.
Section 5, Tap Home Equity, discusses ways to use home equity as part of a retirement income plan. We review the ways to release home equity and how home equity can enhance.
Choose an appropriate strategy for tapping home equity in retirement. So in this learning objective, we're going to discuss how to integrate home equity into a retirement income plan. To do that, we'll start with discussing options for tapping home equity. Then we'll provide some reverse mortgage basic information. Then we'll discuss strategies for using home equity in retirement. Those who are behind in their planning may need to look at home equity as a way to improve their situation. Now, this would be a logical conclusion considering that except for the most affluent segment, home equity represents on average 2/3 of total assets. Now, it's quite interesting that research shows that most people have not considered home equity in their retirement planning process.
Are you being a distraction?
I'm working.
Barb, we think of reverse mortgages as the primary way to access home equity, but there are other ways too. When it might be more appropriate for an older person to consider a conventional home equity loan?
The decision to tap home equity is influenced by several different factors, one of which is the duration in the home. That is, how long are they likely to be wanting to continue to stay in the home? And that will influence the kind of loan options they may want to consider. A reverse mortgage traditionally has been an option for people who want to stay in the home for many years with sizable upfront costs. Amortizing those costs over time, it helps to stay in there for many years. So for people who are unsure of how long they may want to stay in the home, or people who may have other assets that they don't want to tap right away, but that could be used to pay off a conventional loan, some kind of a more conventional home equity line of credit or home loan would be an appropriate option. The advantage of those types of loans is that they may have a lower upfront costs, and so they can be better used for more shorter term situations.
Okay, so simply because the costs are lower, if you've got a temporary situation or a short-term situation, we might be thinking conventional equity lines of credit or something like that versus a reverse mortgage.
Yeah, the challenge with the conventional loan is that a person has to make those monthly payments. Mm-hmm. And if they are in a transitional situation, perhaps they've just had a fall and they've come out of the hospital, they're not sure whether or not they're going to be able to manage on their own, but they need some additional assistance in order to stabilize them or perhaps make some home modifications. Then a conventional loan may be the solution. Amortizing the kind of is influenced by several different factors, one of which is the duration in the home. That is, how long are they likely to be wanting to continue to stay in the home? And that will influence the kind of loan options they may want to consider. A reverse mortgage traditionally has been an option for people who want to stay in the home for many years with sizable upfront costs. Amortizing those costs over time, it helps to stay in there for many years. So for people who are unsure of how long they may want to stay in the home, or people who may have other assets that they don't want to tap right away, but that could be used to pay off a conventional loan, some kind of a more conventional home equity line of credit or home loan would be an appropriate option. The advantage of those types of loans is that they may have lower upfront costs. And so they can be better used for more shorter term situations.
Okay, so simply because the costs are lower, if you've got a temporary situation or a short-term situation, we might be thinking conventional equity lines of credit or something like that versus a reverse mortgage.
Yeah, the challenge with the conventional loan is that a person has to make those monthly payments. Mm-hmm. And if they are in a transitional situation, perhaps they've just had a fall and they've come out of the hospital. They're not sure whether or not they're going to be able to manage on their own, but they need some additional assistance in order to stabilize them or perhaps make some home modifications. Then a conventional loan may be the solution. But the problem, of course, is because they have to keep making those monthly payments, if their health expenses should grow over time, that additional financial burden, along with their regular mortgage payment, homeowner payments or other types of expenses, may get to the point where they have difficulty paying that additional home loan. And so at that point, there's the risk that they could end up in a foreclosure situation. So again, if there are resources that are available that could pay off some kind of a home loan, that would be what you would want to have in place, or else that it would be a shorter term type strategy.
I guess sometimes also they might not be available to someone with lower income because they're not going to qualify for the conventional loan, because they don't have the resources to pay it back. That's going to be an issue.
That's absolutely right. For a conventional loan, the bank is going to look at their ability to repay that loan. They're going to look at their credit worthiness. And for people who've had difficulties, or for older women who may not have much of a credit history of their own, that may be a significant barrier. In contrast to reverse mortgage, the lenders don't look at a person's credit history or their income in deciding, where their eligibility.
And maybe the conventional loan is more appropriate for the wealthier individual who might be trying to accomplish something like, that we've had a down market and their assets have dropped 30 or 40%, and they don't want to sell those assets. So that might be one reason they can do it. I guess other wealthier individuals might look at, the cost of borrowing right now, which is really quite low, and also the deduction they get on interest payments, and think it's a pretty good deal, and would rather use their money to invest in other things. I guess so I think you told me that a lot of wealthier individuals, older individuals, have tapped into their equity in their home. Isn't that the case today?
That's right. Obviously, people with more resources have more options. And that one of those options could be tapping their equity as part of their overall financial plans in terms of how they allocate their assets in their portfolio and how they put those assets to use. So absolutely, that is definitely an option. Again, it's very important to think of this as part of overall retirement planning or financial strategy, because the house is a finite resource, and to the extent that you encumber it with one type of loan, you may not necessarily be able to use it for other needs down the line. And to the extent, as I said, that they have to make that monthly payment, that could become a crunch point sometime in the future.
Okay, besides conventional loans and reverse mortgages, are there any other options available?
For people with modest resources, many states offer what are known as single-purpose loans. And those are designed for people who have immediate needs, specifically seniors, such as property tax deferral loan. It works similarly to a reverse mortgage in that a person is able to defer a payment of their property taxes until they leave the home, at which time the loan with interest comes due and is payable to the state. There are also home repair programs, which again work similar in that the state will give them some money in advance to repair the home so they can stay at home, and then it would be paid at a later date. The advantage of these types of programs is that they tend to be lower cost loans. In some cases, the loan may be forgiven if a person stays at home for many years and isn't a candidate for Medicaid or something like that. The disadvantage of those types of loans is the fact that they are single purpose. So once you've encumbered the house with that type of a loan, you may not be able to use the rest of the equity for other needs.
Oh, okay. And then I think there's also income limits typically on those types of programs, right? So
Right.
they're only going to be available to people with modest income.
Yeah, it would vary by state and community. And in some cases, there may be some areas of the country where they may not be available at all because the state or community doesn't offer that type of a loan, single purpose loan. And yeah, they probably are going to be targeted to those probably more middle and lower middle income folks.
I guess I always think of one of the simplest ways to tap your equity in your home is to downsize, to sell the home and either rent or move into a smaller facility or a smaller home or a condo. It seems to me that idea is sort of underutilized. What do you think about that?
Actually, I think that's probably what most people do, is that they decide that the home is more than they can handle and they decide to move. Fortunately, what happens is people tend to wait until there's a crisis to make that kind of a decision. And trying to sell a home or even take out some kind of a home loan during a crisis situation is very difficult. And so one of the challenges with the wait and see approach is that if you wait too long, you may not have a lot of options. The other challenge is
Almost all reverse mortgages today are made of the.
So, the RICP program, they recently enhanced everything to where it's a newer version of the RICP courses. And because I started my RICP, Retirement Income Certified Professional Curriculum, prior to just prior to them making the enhancements, I had the option of staying where I was or opting to do the enhanced. Since I had already started on the original, I just kept it this way. But one thing that I don't like about this system is what it does is it sends, it clips to the next screen before the actual video is done. But so what I have to do is I just hit back and then go back.
To live.
Absolutely.
Okay,
Yeah.
interesting. Then that, we're talking about sort of all the different options. That sort of leads us back to the reverse mortgage. Sort of on the highest level, when do you think is, the reverse mortgage the appropriate choice then as a way to tap home equity?
Well, certainly for many people, a reverse mortgage is going to be a better solution if they plan to live in that house for many years, because it does come with additional consumer protections, such as the fact that these types of loans are non-recourse loans, which means that if a person, when the loan comes due, when the person leaves the house, that if they sell the house at that time, that they never owe more than the value of their house. If they sell the house for more than the loan is due, they of course get to keep the difference. But that's a very important consumer protection for those people who are staying in the home for a long period of time. There's also different kinds of payment options. You can have it as a lump sum, a line of credit, or some kind of a 10-year payment for either in the life in the home or else for a shorter period. And it's possible to switch from one type of payment option to another very easily, so that it provides a lot of flexibility to the person who may have changing needs over time.
Okay, that's great. Thank you.
This video was made possible by the New York Life Center for Retirement Income.
See, this is one of the things that I like about this RICP training. Prior to me hearing that explanation, I would have always said there's never a good time for a reverse mortgage. I mean, if you're somebody who is looking to, pass the property to the next generation, because a lot of the things, the disadvantages of reverse mortgages is once you pass away, and I'm pretty sure it's going to get into the basics, more details on basics, so how it works. But my understanding initially was whoever your heirs are would have a small amount of time, up to 9 months at the most, to pay the money that's owed on the reverse mortgage, and if not, then it's taken. And that might very well still be true, but a good benefit because what she was saying was a lot of people probably just won't qualify for a reverse mortgage. They might not have the income to pay it off. So, well, not a a conventional mortgage. They might not have the income to pay the monthly note. And if you plan on being there for a long time, and well, let's see what these options are.
Almost all reverse mortgages today are made under the Home Equity Conversion Mortgage Program. The HECM program encourages lenders to make loans by providing FHA insurance protection in case the loan is not fully paid back. With the HECM loan, all borrowers have to be age 62 or older. The loan can only be taken on a principal residence. How much can be borrowed will be tied to the borrower's conversion mortgage program. The home equity. All reverse mortgages today are made under the Home Equity Conversion Mortgage Program. The HECM program encourages lenders to make loans by providing FHA insurance protection in case the loan is not fully paid back. With the HECM loan, all borrowers have to be age 62 or older. The loan can only be taken on a principal residence. How much can be borrowed will be tied to the borrower's age, the value of the home, and current interest rates. What makes this type of loan different than a conventional loan is that the loan does not have to be paid back until the borrower permanently leaves the home, although loan payments can be made sooner. The HECM has additional fees not found in traditional loans, the primary one being an FHA insurance premium. If fees are financed and loan payments are not made, the outstanding loan balance can grow significantly over time. Reverse mortgage loans are non-recourse, meaning that the maximum amount that has to be repaid is the value of the home. If property values have eroded and the outstanding balance on the loan exceeds the value of the home, the homeowner or the heirs are not responsible for the difference. This is the situation in which the FHA would make up the difference. If the home's value exceeds the outstanding loan amount, the owner or heirs would receive the windfall when the home is sold. Since the transaction is a loan, there are no income tax consequences when the homeowner receives payments or the loan is repaid. There are a number of different payment options available under a HECM loan. Options include a lump sum, a line of credit, and a tenure option, meaning that monthly payments are paid for as long as the borrower remains in the home. Since the loan balance grows with interest, the homeowner will use up less equity in the long run by withdrawing amounts only as the income is needed, meaning that the line of credit or monthly payments are often the best options.
There are many ways to use a HECM reverse mortgage within a retirement income plan, as shown in this chart. Strategies are ordered from those that spend available credit more quickly to those that open the line of credit as a type of insurance backstop that may never need to be tapped. We consider these in turn. First, coordinating housing-related issues with the investment portfolio and a reverse mortgage can be a critical step in a structurally sound retirement plan. Briefly, for those not carrying a substantial mortgage into retirement, a simple HECM use is to fund home renovations to better support the ability to age in place. This may help retirees to remain in their homes for longer, reducing pressure to make or delaying a move to a more institutionalized setting. Other options include providing an alternative to carrying a traditional mortgage into retirement or using the HECM for Purchase program to purchase a new home in retirement. Mortgage debt in retirement presents an additional planning challenge. For retirement distributions, fixed payments related to paying off debt create a strain for retirees due to the heightened withdrawal needs triggering greater exposure to sequence of returns risk. Exposure rises because the debt payments are fixed and require greater distributions than otherwise. So if there is a market decline early in retirement, the portfolio is further strained as an even greater percentage of what is left in the portfolio must be taken to meet these fixed expenses. Sequence risk is further exacerbated by having a higher distribution need in early retirement on account of the mortgage payments. The general idea is that a reverse mortgage used primarily to refinance an existing mortgage creates more flexibility for distributions from the investment portfolio by removing a fixed expense from the household budgeting in the pivotal early retirement years. During pre-retirement, it is common to pay the mortgage more slowly in hopes that investment returns will outpace the borrowing costs on the mortgage. This approach becomes riskier in retirement as distribution needs heighten the retiree's vulnerability. Strategies are ordered from those that spend available credit more quickly to those that open the line of credit as a type of insurance backstop that may never need to be tapped. We consider these in turn. First, coordinating housing-related issues with the investment portfolio and a reverse mortgage can be a critical step in a structurally sound retirement plan. Briefly, for those not carrying a substantial mortgage into retirement, a simple HECM use is to fund home renovations to better support the ability to age in place. This may help retirees to remain in their homes for longer, reducing pressure to make or delaying a move to a more institutionalized setting. Other options include providing an alternative to carrying a traditional mortgage into retirement or using the HECM for Purchase program to purchase a new home in retirement. Mortgage debt in retirement presents an additional planning challenge. For retirement distributions, fixed payments related to paying off debt create a strain for retirees due to the heightened withdrawal needs triggering greater exposure to sequence of returns risk. Exposure rises because the debt payments are fixed and require greater distributions than otherwise. So if there is a market decline early in retirement, the portfolio is further strained as an even greater percentage of what is left in the portfolio must be taken to meet these fixed expenses. Sequence risk is further exacerbated by having a higher distribution need in early retirement on account of the mortgage payments. The general idea is that a reverse mortgage used primarily to refinance an existing mortgage creates more flexibility for distributions from the investment portfolio by removing a fixed expense from the household budgeting in the pivotal early retirement years. During pre-retirement, it is common to pay the mortgage more slowly in hopes that investment returns will outpace the borrowing costs on the mortgage. This approach becomes riskier in retirement as distribution needs heighten the retiree's vulnerability and exposure to market volatility. In addition, a changing tax situation with the loss of wages and the dwindling mortgage balance in retirement could mean losing potential tax deductions from mortgage interest that were taken prior to retirement. For retirees still carrying a traditional mortgage, two options are to use a HECM to refinance the existing mortgage and then not worrying about repaying a loan balance until it becomes due, or to use the HECM to refinance an existing mortgage and then continue making voluntary payments to reduce the size of the loan balance and increase the available line of credit throughout retirement. The ability to mitigate sequence of returns risk by refinancing the mortgage with a HECM can be beneficial enough to offset its costs. The second category of uses is to coordinate spending from investment portfolios with the reverse mortgage when funding the retirement spending goal. Sequence risk increases with higher withdrawal rates. Drawing from a reverse mortgage has the potential to mitigate this aspect of sequence risk for an investment portfolio by reducing the need for portfolio withdrawals either generally or just at inopportune times. Coordinating potential spending with distributions from a reverse mortgage line of credit can be an effective way to help manage the sequence of returns risk in retirement. This has been demonstrated in a series of research articles since 2012, highlighting how the strategic use of reverse mortgage can either preserve greater overall legacy wealth for a given spending goal or otherwise sustain a higher spending amount for longer in retirement. We discussed that research further in Competency 16 in the third RICP course. The conventional wisdom on how to treat housing wealth in retirement was to preserve it as a last resort asset for when all else has failed. The failure to coordinate home equity with the investment portfolio or to attach a growing line of credit to home equity leads to less efficient retirement outcomes by not fully realizing potential ways to manage sequence risk. A reverse mortgage can reduce the need to maintain a larger cash buffer, provide the flexibility to hold on to investments during bear markets, allow flexibility to use home equity as a source of spending, and improve portfolio survivorship rates without an adverse impact on remaining legacy wealth. For the third category, a reverse mortgage may be helpful as a resource to support certain long-term strategies that require paying short-term costs to obtain long-term benefits. Examples of these efficiency improvements include to use the 10-year payment option as an alternative to purchasing an income annuity, to create a Social Security delay bridge that we discussed with Social Security to help support delaying Social Security benefits, to use the reverse mortgage as an alternative source of longevity insurance, to pay for taxes to enable Roth conversions in the years prior to required minimum distributions, to otherwise help manage falling into a higher than necessary tax bracket, and to maintain an existing long-term care insurance policy by paying insurance premiums from the line of credit. The final use for a reverse mortgage is to preserve the line of credit as an insurance policy against a variety of retirement risks. Preserving credit as insurance involves setting up a HECM reverse mortgage as early as possible and then leaving it unused until needed. The upfront costs for the reverse mortgage could be treated as an insurance premium that may never need to be used if everything else goes well in retirement. However, a variety of potential pitfalls face retirees, and implementing a reverse mortgage earlier in retirement could support a sizable pool of contingency assets. Potential insurance provided by the growing line of credit in this context include protection from declining home values as a means to pay for in-home care to avoid or at least to delay the need to move to an institution, or as a way to split the home equity in the event of a divorce.
The first step in planning is simply bringing home equity into the retirement income conversation. For the client that has an income shortfall, home equity may be part of the answer. Let's review some of the ways to use home equity that we discussed in the video. If the goal is using home equity to create a regular income stream, there are a number of options. One option is to downsize, that is, sell the home and buy a less expensive one, or rent to create additional assets that can be used to generate additional current or future income. This may be the simplest way to free up equity, but it may not meet the client's retirement objectives, or there may not be adequate cheaper housing in the desired neighborhood. On the other hand, for some clients, this may be a great way to free up equity, possibly lowering living expenses and finding more appropriate housing for later in life as well. This may also be part of a relocation plan, especially if the client chooses an area with lower housing and living expenses. For the client wanting to stay in the home, another option is to take a reverse mortgage and elect a 10-year option to generate a steady stream of additional income over the time that the individual stays in the home. The advantage of this approach is that it allows the client to stay in the home, uses up the home equity more slowly as the amount borrowed builds slowly. The limitation is that the income will stop when the client leaves the home, and the outstanding loan amount may use up a significant portion of the equity if income payments continue for many years. A third option is to take reverse mortgage with a line of credit distribution option and take withdrawals for a limited period of time to defer Social Security benefits. This strategy requires borrowing at a young age and interest may accrue for many years, but it gives the client the ability to increase income as deferring Social Security from 62 to 70 increases benefits by 76%. Another way to use outstanding debts. Some debt can be removed by downsizing, especially for those who choose to rent instead of purchasing another home. Another option is to use a reverse mortgage to retire.
Be right back.